Today, I'll answer the question of what kind of ETFs are there for me to buy. And of course, I'll have examples in case you're interested to dig a little deeper. Now, all the ETFs that I will be mentioning are US listed unless I say otherwise. Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll save, invest, and feel better about money. Let's start with the most popular in the world, which is the Index ETF. You can think of an index like a benchmark of sorts, and there are companies who create these indexes, and then there are ETF providers which create ETFs to follow these indexes. If you wanted to dig deeper into index funds, I have a whole video about that, so you can check that out. Otherwise, you would have likely encountered an index ETF without realizing that it is one. And the most popular one in the world in terms of assets under management is SPY, which tracks the S&P 500 index. A couple of important points: just because two ETFs sound like they have the same name, it doesn't mean that the underlying assets are the same. And it's because they are different index providers. That's why it's always important to double check what is it you're really buying. And it's also important to note that not all ETFs are index ETFs. Besides SPY, a couple of other really popular index ETFs are QQQ, which tracks the Nasdaq 100, or VT, which tracks the total world stock market. Next is a really broad group, which are asset class ETFs. Now, it's a bit strange because sometimes you'll see the term asset class being used in different ways. So let me start with the proper one, which is defining asset class as cash, stocks, fixed income or bonds, real estate, and commodities. Earlier, I mentioned SPY, QQQ, and VT, and those are simply just stocks. And then you have things like VNQ, which tracks the total US real estate market. An example of a real estate ETF in Singapore is something like CLR, the Lion Phillip S-REIT ETF. For fixed income or bonds, one of the most popular ones in the US is BND, which tracks the total US bond market. And an example from commodities is the ever popular gold ETF GLD. Now, in your journey of learning investing, you might sometimes see people use the term asset class in a different way to define different categories. One of them could be used to describe sector type ETFs. For example, you can buy into the energy sector with an ETF like XLE, the financial sector, which is XLF, or maybe buying utilities, which is XLU. The second category could be in reference to regions around the world, which bundle multiple countries together into one ETF. The most popular ones could be something like Europe, which you could invest in through IEUR, or buying into emerging markets where we are through an ETF like IEMG. The final asset class category could be something like factor-based ETFs. Now you can think of factors as the characteristics of a stock, which explains the stock's performance. For example, you would have likely heard of the term value investing, which seems to be like the most popular style for a lot of established investors, such as Warren Buffett. Value here is a specific factor, and it simply means the belief that when you buy a stock where prices are lower than its value, you will get rewarded by the markets eventually. The other really popular one these days are growth, where the underlying stock is growing at a very fast pace. And you have factors like size, which are maybe small cap, medium cap, or large cap. And cap here simply refers to market capitalization. Or it could be something like momentum, which is the belief that if prices are moving in one direction, it tends to stay moving in that direction. It can be a really mixed bag here, depending on what you're looking for. For example, there are single factor ETFs. Maybe you wanted US small cap stocks, you can buy that through SCHA. Or if you wanted multiple factors, maybe you could look into small cap value, and you can buy that through VBR. Plus, you can find ETFs that sometimes cross a few of these categories together. For example, there is AVEM, which is an emerging markets ETF that combines factors as well, such as value and profitability. Now, whatever I've just covered are what I would call fairly vanilla ETFs. And before I get into the more adventurous ones, If you find value out of this video so far, I would appreciate your support in clicking that like and maybe even comment down below, because that really does help my channel grow. Thanks. Now let's begin to explore some of the newer type of ETFs out there, beginning with actively managed ETFs. So this is unlike index or passive ETFs, which usually doesn't change very often. This kind of ETF has been really popularized thanks to investors like Cathie Wood with her ARK Invest company. Her flagship ETF, which is ARKK, invests in different disruptive technologies, about 50 or so stocks, and it's an actively managed ETF. But it's important to know that not all active ETFs are as concentrated, meaning holding very few stocks, or as aggressive, such as Cathie Wood in the way she invests. You have other type of ETF providers, such as Avantis, where they have a blend of styles where they match index investing with active management. And this leads us to one of the fastest growing type of ETFs, which is the thematic ETF. You have ETFs like ARKG, which follows the theme of genomics. The company Global X has an ETF that tracks the robotics and AI theme called BOTZ, B-O-T-Z. And then you have a newer upcoming type of ETF, which is the ETF of ETFs. For example, in Germany, Vanguard has this group of ETFs called a Life Strategy, which basically combines stocks and bonds all in one ETF. And since we're talking about Germany, there are certain ETFs that might be listed in either Germany, the UK, or a few other countries in Europe, and they are termed as UCITS ETFs, UCITS. Think of them as a special class of ETFs, which really matter for those of us in Singapore or Malaysia because they help us save on taxes. In case you didn't know, anytime you earn dividends or income from a US-based asset, you tend to be charged 30% of what you call a withholding tax. Now, if you are able to find an alternative UCITS ETF, you are able to save half of that tax, because UCITS charge you a 15% withholding tax. So for example, instead of buying SPY, which is listed in the US, you could buy something like CSPX, which is listed in London. Finally, we get to the most exotic bunch of ETFs, which tend to use derivatives in how they build the ETF itself, and it could be options, futures, or swaps. The most tame of the lot are the commodity-based ETFs. Now, remember earlier I mentioned gold with GLD? They hold physical gold, which is quite different than how some of these other ETFs operate. Examples are like DBC, which tracks a basket of commodities which is weighted mostly towards energy. And then you could have something like DBA, which tracks an agricultural index. And then you have leveraged ETFs, where these guys are targeting a specific asset, but the ETF aims to deliver you 2 times or 3 times the daily performance of that underlying thing they're tracking. For example, there's an ETF called SSO, which is the ProShares Ultra S&P 500. It targets to give you 2x what the daily performance of the S&P 500 is. If the S&P 500 went up by 2%, SSO would go up by 4%. The logic works in reverse as well, because if it went down by 2, you would have went down by 4. Without getting too technical, these are not long-term holding type of ETFs. The way they track the prices simply doesn't stack up normally, and that's why people tend to use them mostly as trading tools. The close cousin of the leveraged ETF is the inverse ETF. Like the name says, it tracks the inverse or opposite performance of the underlying asset. For example, there's the ProShares Short S&P 500 under the ticker SH. So if the S&P 500 went down by 2%, you would have gone up by 2% if you bought this ETF. And this brings us finally to one of the newest type of ETFs that are out there. Late last year, a company called Simplify launched a suite of ETFs that use options within them that aims to take advantage of extreme moves in the markets. They have one called SPD, which tracks the S&P 500, but within the ETF, it has put contracts as well. So in theory, if the S&P 500 takes a steep and sudden dive, the underlying put options will go up in value and therefore offset the loss that you might have had. All these exotic ETFs I talked about are definitely on the fringe of what the majority of investors would be using. But I think it's just useful for you to know that they are out there and the space continues to evolve. I've got 3 parting notes for you before I go, and the first one is that just because there are so many of these ETFs out there, it does not mean you have to use them all. More often than not, keeping it simple is simply the best thing to do. For anything that you are interested in investing in, just remember that it's very likely going to be additional options out there which you might not have heard of. Always do extra research because you might find another ETF that fits the goal better, or it's just cheaper. Finally, always double check what's in the ETF itself, because even though they might have the same name, the underlying assets might not be the same. So with that said, I hope you enjoyed this worldwide tour about what ETFs are there available for you to buy. If you've got any questions, leave them in the comments below and I'll get to them. So if you got value out of this, I would appreciate your support by clicking that like, sub and bell button, and I'm going to be back again next Sunday with a brand new video. And until then, you take care and keep playing your own game.